It's been a big week for financial markets. Finally, we seem to have come to some sort of resolution in Greece with an agreement that was struck on Monday night. Now, many commentators look into this agreement and can see quite wide gaps in terms of how the ability of Greece really to meet its objectives. For example, over the course of the period until 2020, Greece has got the objective of bringing down its debt to GDP ratio to 120%, and clearly on a sort of worst case scenario that number is well north of 160%. So I think that whilst this deal has certainly bought time and bought some breathing space for Europe, by no means is this going to be the ultimate conclusion to the Greece situation. We expect this is going to be a situation that will rumble on in the background for some years to come. There's one other thing just to keep an eye on in the Greece deal that I think is worthy of some attention. And that is in terms of trying to get to some agreement. There has been some interesting features about this deal, which in particular relates to the role of the ECB. The European Central Bank has, to some extent, been largely protected from any losses. And you will hear more and more about the issue of CACs. These are designed to some extent to give ability for retrospective changes to bond terms. And the only point to make here is that when we look at other periphery debt throughout Europe, we just need to be careful about the ability to change terms, and this to some extent subordinates commercial bank holdings compared to, say, the central bank, and that may in time just give consideration to people demanding a higher yield from European bonds compared to, as I say, what they have at the moment. So just one to keep an eye on. It's not all smooth sailing, but saying that, I think markets are taking the positives out of this deal in the breathing space, and we can see that sort of translating in a number of risk asset classes through the course of this week. So we're going to whiz through a few of these charts, starting off here with the FTSE 100 index. Indeed, FTSE is doing well, and indeed we're getting very close now to the 6,000 level on the chart, so the upward trend is in place, which is encouraging, but it's not the best performing market. To some extent, the London market is a little bit too defensive in these periods. If we're looking for a little bit more action, it's the DAX here in Germany, which has certainly, during the course of 2012, had a much better performance, twice that of the UK at the moment. Turning back to the UK, one of the other big features of the week has been the banking sector. We've had results out here from Lloyds TSB and also pull up the chart for Royal Bank of Scotland. And I think the common feature in both sets of accounts of these banks is that 3 years into the strategic reviews, they're largely on plan to contract their balance sheet down to manageable size. It's worth just reminding ourselves how big Royal Bank of Scotland actually became in 2007-2008. It was larger than the UK economy. Ultimately, if it was to go wrong, it was only the UK taxpayer that could sort it out, and where the lack of control took place in the banking sector in the run-up to that 2007 was allowing these banks to become too big. And over the last 3 years, the Royal Bank of Scotland has virtually halved the size of its business. It's disposed of over £700 billion worth of funded commitments going forward. And so where you will see headlines that suggest they are making losses, and maybe those losses are slightly higher than expectations, and there's always a tie-in to some extent to the question of losses and bonuses, I think it's worth just reiterating that you've got two aspects to the business. You've got the business going forward, which is extremely profitable in both cases. On Lloyds and RBS, we're talking about £6 billion of profit for this year. But the faster they can get through the process of contracting the balance sheet, the more losses they will take. So to some extent, you can argue that bigger losses at this stage is a recognition of just the success they're having in contracting that balance sheet, and they need to do that quickly just in case we have other issues in sovereign debt which continue to impact on banks' abilities to move forward. So that's the banking sector. Other stocks that I just want to mention this week in terms of results, I think Capita is an example for me of a company that has seen a very strong upward price movement on the back of results, and I've seen it time and time this week of companies that have been meeting expectations and seeing maybe 10 to 15% appreciations in the share prices. That's an encouraging sign for me for the UK market that share prices are responding positively to good results at the moment. It gives an indication there's a little bit more left in share prices, rather than feeling that they're topping out at the moment. So that's been an encouraging feature for this week. Just turning to some of the other asset classes, I want to look at the oil market. Oil is bubbling up, the oil price, and particularly when we quote oil, we often quote it in dollars or in pounds without really, as I say, thinking about the underlying effect. This is a chart of oil priced in euros, and likewise I'm going to just pop the next chart up, which is oil priced in sterling. And what we're seeing here is that oil has now hit an all-time high price in this sterling-based currency. Now, to some extent, you will have seen oil prices quoted in previous years higher than where it is today, but it is the devaluation of the currency over the period of time which is making oil a much more expensive commodity, particularly here in the UK. And just if this were to persist, we have to think a little bit back to Bank of England comments that have taken place in the course of the last few weeks surrounding inflation, in the sense that we're starting to see inflation decline in this country as VAT comes out, but we have to be a little bit careful. Could oil become the next nasty surprise? So this is certainly something. So this is something which we should be watching quite carefully. In the background, we are actually hearing comment here from the UK GDP. This is a preliminary estimate of what happened to the UK economy in the fourth quarter. Now, the estimate was for 0.2% decline in the economy during that period of time. What number did we see there, John?
Yeah, inline down 0.2%.
So it looks like an inline number there for the UK GDP figure for the UK, and that may well indeed just help stabilise sterling. Just pull up a little chart of sterling here. Sterling has been sort of reasonably steady against the dollar over this period of time, which has been good. That's despite the fact that the Bank of England had two members voting for stronger QE programs going forward this year. But one chart I do think is interesting is how the euro has been strengthening during the course of the week on the back of the Greek numbers. It's absorbing some pretty weak data coming out of the European Commission that was downgrading much of the Eurozone growth forecast for this year. But the Eurozone has been bouncing back, and you can see there, particularly against the UK sterling, how weak we've become against the euro at the moment. So again, currency is becoming a little bit of a feature on this market.